Here we have with us Mr. Jeremy East, Managing Director, Standard Chartered Bank from Hong Kong. Good morning, sir, and welcome to Bullion Bulletin and 11th India International Gold Convention. It is a pleasure to have you here. My first question is, demand for gold in the major consuming centers like India and China is decreasing. So, what can possibly be the effect of this global changes, and why this market is moving in downward direction?
I think we've got two different things going on at the moment. India demand definitely has decreased on an official basis. However, China still seems to be going forward very strongly. Last year, China imported over 1,400 tons of gold, and this year I expect the number not to be as great as last year, however, still to be over 1,000 tons, so quite significant amounts. So I think the demand for the market is still very strong.
You don't feel that it is in a decreasing trend?
No, I think if anything, the physical markets are turning, and for next year we will see an increase in physical demand. As I said, India I think is going to be coming back next year. China will be strong, and also especially with the recovery in the US economy, I think we'll see stronger jewelry demand in the US.
As you say that there is no decreasing trend, it will increase further in next year. But again, the price is also in the downside. So how are you looking at it? If it will continue, so how will it impact the overall global trend in bullion?
I think if you look at the market, the gold market often is influenced by interest rates and the strength of the US dollar. The strength of interest rates and the US dollar are generally bad for gold. So I think we're seeing selling coming from the more investor community. The more strategic community are selling gold at the moment with the expectation we'll see lower prices. However, just below the market, around 1,100 is the marginal cost of production. So at this point, mining companies will start to reduce their production levels.
Coming to Asian market, Asian giants like Singapore, Hong Kong, China, India, they are coming out with so many innovative investment options for gold, and we are thinking about gold moving west from towards east. So how are you looking at this situation, and is there any greater integration possible between these players to make Asia even more stronger in this trade?
I mean, good question. I think because I've relocated to Asia a year ago and based in Hong Kong, focused on initially on the China market. However, we're also very active in Southeast Asia and the Singapore market, and I think you have to differentiate the two. There's quite a big difference. China is very much a domestic market which is growing now internationally. Singapore is developing a new gold contract, and they're focusing on the regional markets. So they're focusing on markets like Thailand, Malaysia, Indonesia.
Shanghai Gold Exchange, it is only involving this LBMA accredited refiners for trading purpose. So is the local refiners and mining people are involved in Shanghai Gold Exchange as well? What is their involvement in this exchange?
Yeah, if you look at the Shanghai Gold Exchange, the LBMA delivery refiners are approved there. However, in addition, there are a number of domestic refiners that have been approved on the authorized list from the exchange.
Coming to China, China is also planning to launch its own local price fix. So how are you looking at it? Is it going to happen anytime soon?
I think as China develops its new gold contract in the free trade zone, it's only natural that Asia starts to develop benchmarks, and we're already seeing a move to that. China imports something like 30% or more than 30% of world gold production, and associated with the internationalization of the RMB, why shouldn't China pay for that gold in local currency? And if it's physical gold, then often physical contracts are linked to benchmarks. So I think it's only natural that China would look to launch its own benchmark, especially in local currency in the free trade zone.
Coming to India, there has been import restriction. That is a great constraint for our country, and as India is one of the largest consumer, do you feel that bullion banks like you can participate in a better way with India to neutralize this event and to help India get out of it? How can it involve in a better way, the bullion banks?
It's a good question, but actually very difficult for the bullion banks, the international banks, because we work with our clients in geographies. What's going on in India is really a domestic concern, which is, for the clients to focus on. We can give our advice to the clients and give them experience in the international markets and other markets where we're trading. Ultimately, it's the responsibility of the domestic market to resolve these things.
Like gold financialization in China, it is like one of the best in the world. So do you feel that this Chinese scheme of gold financialization we can opt in India as well? It can help India.
You're talking about the distribution of gold. So yes, the Chinese have been very successful in developing distribution networks. The government supporting the domestic banks, and the banks have been able to build huge retail distribution networks for gold, small bars, coins, all over China. And in addition to that, we've seen a huge growth in retail. So the jewelry companies have dramatically increased their distribution capability in retail jewelry. So with the government support, there's been a big success in that.
Coming to Europe, European Central Bank and other European banks, they have agreed on a new central bank agreement that will continue for next 5 years. So as it is renewed again, how are you looking at this situation and how will it help again for bullion industry?
I think at the moment where we are in terms of the market, this agreement is it's important, but it's not going to have a major impact in the market. It limits the amount of gold that central banks sell and also the amount of gold that they lend into the market. And at the moment, I think central banks are net buyers of gold, if anything. So I think the impact of that is muted. Yeah.
How are you looking at this Chinese demand for the next 2-3 years?
The demand in China is we're seeing quite a big pickup at the moment. I think we'll see that continue to grow into next year. I think what we'll see now is the policy from Chinese government is supportive to the gold industry, and I think we'll see as China becomes more wealthy, growth develops, they will consume more gold. And so I think we can expect to see increased demand over the next 2 or 3 years coming from China.
Finally, a word for this event, sir, 11th India International Gold Convention. So how are you enjoying this event?
It's great. It's like a real community here, a lot of old friends. I think it's one of the best conferences that I go to on a regular basis.
Thank you very much, sir.
Take care.